Something broke in the silver market today. Not the long-term story, not the supply deficit, not the industrial demand. What broke was the mechanism underneath the market itself. In a single session, silver lost more than 8% of its value. At one point, it was down more than 10%. And the strange part is that nothing about silver's real-world demand suddenly disappeared overnight. Factories didn't stop building solar panels. Semiconductor plants didn't pause production. Defense contractors didn't remove silver from advanced electronics. The physical story didn't change. What changed was leverage. Right now, silver is sitting around $81 at $91. Gold has slipped back toward $5,076 after dropping nearly 5%. Platinum was hit even harder, plunging more than 10%. The S&P 500 is down more than 2%. The dollar index just surged to its highest level in weeks, and the 10-year Treasury yield jumped sharply. At the same time, oil prices exploded higher. Every one of those numbers is connected. But most coverage you'll see today is treating them like separate headlines. Oil surge, Iran strike, dollar rally, metals falling. The reality is that these events are all pieces of one system reacting to the same shock at the same time. And once you understand how those pieces interact, the drop in silver begins to look very different. The trigger for all of this began over the weekend when tensions in the Middle East escalated dramatically. Military strikes between major regional powers suddenly pushed one of the world's most critical shipping routes into crisis territory. The Strait of Hormuz, through which a massive share of global energy shipments travel, became a focal point of geopolitical risk almost overnight. Markets reacted instantly. Gold surged above $5,400. Silver raced toward $96. Investors rushed into hard assets exactly the way history says they should when geopolitical instability threatens financial systems. But then, something unexpected happened. Oil kept rising, and the bond market didn't behave the way it normally does during a crisis. In nearly every major geopolitical shock over the past several decades, money has rushed into U.S. Treasury bonds as investors look for safety. When that happens, bond prices rise and yields fall. That pattern appeared during the Gulf War. It appeared after the attacks of 2001. It appeared again during the early stages of the Russia-Ukraine conflict. But this time, the opposite occurred. Instead of falling, bond yields began climbing. Within just a couple of days, the 10-year Treasury yield jumped sharply higher, even while global uncertainty increased. That kind of move signals something important about how markets are interpreting the situation. Investors aren't just looking at the conflict itself. They're looking at what the conflict does to inflation. Oil prices above $80 create powerful pressure across the entire economy. Energy feeds directly into transportation. Manufacturing, agriculture, and consumer goods are all impacted. When energy costs surge, ripple effects appear everywhere. And if inflation begins accelerating again because of an oil shock, central banks suddenly face a much more difficult decision. They can't easily cut interest rates in the middle of rising inflation. They might even be forced to keep policy tighter for longer. That single calculation changes everything. When markets begin pricing the possibility that interest rates stay high during a geopolitical crisis, the traditional safe haven behavior of bonds starts to break down. Instead of rushing into government debt, large investors move into the most liquid asset available while they reassess risk, cash, short-term dollar instruments. That's why the US dollar suddenly surged. But in the scramble for liquidity, leveraged positions across multiple markets started getting squeezed. Stocks were falling, metals were volatile, and when that kind of multi-asset drawdown happens simultaneously, brokers begin issuing margin calls. This is the moment where the mechanics of financial markets take over, a trader who used leverage to ride silver from the low 70s. To nearly $96 may suddenly see their position dropping, while their stock portfolio is also falling and the broader market is unstable. The broker doesn't care about long-term theses or macroeconomic arguments. They want collateral. If the trader cannot immediately provide more cash, the position gets liquidated automatically. That forced liquidation creates selling pressure that has nothing to do with silver's underlying value. It's simply the mathematics of leverage colliding with volatility. And there is a very specific signal that reveals when this kind of forced selling is happening. The gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When both metals are rising, because investors want exposure to precious metals, the ratio tends to shrink, as silver often moves faster than gold. But when leveraged silver positions begin unwinding, the ratio expands rapidly, because silver falls faster than gold. Understanding these dynamics is crucial for navigating volatile financial markets. Over just a few days, that ratio jumped from around 57 to more than 62. That kind of move doesn't usually happen because investors suddenly decided silver is fundamentally less valuable. It happens when leveraged traders are being forced out of positions. And the same pattern showed up in another metal today, platinum. Platinum doesn't have the same monetary reputation as gold. It trades much more like an industrial commodity. Yet platinum fell even harder than silver during the same session. That tells you something important about what kind of event this is. When multiple industrial metals drop sharply at the same time during a geopolitical shock, it often means the selling is coming from leveraged positions being unwound across the entire sector. Mechanical selling. And mechanical selling has one defining feature. It ends. The deeper question isn't why prices fell today. The deeper question is whether anything about silver's physical supply and demand changed, because before this crisis began, silver was already running a structural deficit. For several consecutive years, the world has consumed more silver than mines and recycling operations have been able to supply. Solar manufacturing, electric vehicles, advanced electronics, semiconductor fabrication, and military technologies all rely heavily on silver's unmatched electrical conductivity. That demand didn't vanish today. Factories didn't shut down. Technology supply chains didn't suddenly stop requiring silver components. If anything, the new geopolitical situation may actually make certain silver-intensive technologies even more important. Energy shocks push governments and industries to invest more aggressively in alternative energy infrastructure. Solar panels require large quantities of silver to function efficiently. Rising energy prices often accelerate the economic incentives behind those installations. At the same time, the disruption to shipping routes near major energy corridors adds another layer of stress to already fragile global supply chains. Commodity logistics become slower, transportation costs increase, the flow of materials through international shipping routes becomes less predictable. All of those factors can tighten supply conditions rather than loosen them. So what you end up with is a strange situation where the physical market and the paper market begin telling slightly different stories. The futures price on trading screens dropped sharply today as leveraged traders sold contracts to meet margin calls. But reports from dealers tracking physical silver flows suggest something else is happening beneath the surface. Premiums for physical silver have started rising. That means the price someone pays to actually obtain real metal hasn't fallen nearly as much as the futures chart suggests. In some cases, it has moved the opposite direction. That kind of divergence often appears during forced liquidations. Paper contracts can be dumped quickly when traders need cash. Physical metal, however, moves through supply chains tied to industrial demand and real inventory. When these two markets diverge, it reveals if a sell-off is driven by fundamentals or short-term financial pressure. If investors believed the long-term story for silver had collapsed, physical buyers would step back. Premiums would shrink and demand would cool. Instead, physical buyers appear to be stepping in. That behavior suggests the market may be experiencing a temporary dislocation rather than a fundamental repricing. Historically, dislocations between paper prices and physical demand rarely last forever. Either the paper price rises toward physical demand, or physical shortages tighten inventories. Both paths eventually reconnect price with reality. The bigger picture is that the financial system itself may be entering a period of unusually high stress. Stock valuations remain elevated, global debt is high, energy markets are volatile, and geopolitical tensions are rising. When these conditions combine with heavy leverage, volatility accelerates quickly. That's exactly the kind of environment silver has historically thrived in. But it's also the kind of environment that produces violent short-term swings. Silver moved from roughly $72 to $96 during the recent rally. Now it has given back more than 8% of that gain in a single session. Moves of that magnitude don't happen in calm markets. They happen when systemic pressure begins building beneath the surface. When volatility appears in a market already dealing with structural supply constraints, the resolution often arrives through another powerful move. The real question now is whether the forced liquidation is nearly finished or just beginning. Traders are watching a couple of price levels closely over the next few sessions. If silver stabilizes and reclaims the mid-80s range quickly, it could signal margin calls are absorbed. New buyers would then be stepping into the market. But if prices break significantly lower and remain under pressure, additional leverage positions may unwind. Either scenario will reveal itself fairly quickly because forced selling rarely drags on quietly. Beneath all the short-term volatility, the longer-term story remains surprisingly consistent. Central banks accumulate gold at record levels, diversifying from traditional reserve assets. Governments run large fiscal deficits. Industrial demand for conductive metals expands as new technologies scale. Those trends existed before this week's geopolitical shock. The shock didn't create them. It simply accelerated the speed at which markets must react to them. Which brings us back to the strange moment we're witnessing today. On the screen in front of you, silver is trading around $81.91. But that number represents the price of leveraged futures contracts changing hands in a liquidation event. It does not necessarily represent the price industrial buyers are willing to pay for physical supply. It does not fully reflect the structural deficit that has been building in the background for years, and it certainly doesn't capture the long-term forces shaping global demand for conductive metals. In a world becoming increasingly dependent on advanced technology and electrification, Markets often experience moments where financial pressure temporarily pushes prices away from underlying fundamentals. Those moments rarely last forever. Eventually, the forced sellers run out of positions to liquidate. The margin calls stop, and the market begins discovering where real buyers are willing to step in. Sometimes, those turning points appear when confidence feels lowest and volatility feels highest. So here's the question we're thinking about as this situation develops. Is this the beginning of a deeper breakdown, or the moment when leverage gets flushed out, before the next major move begins? Because in markets like this, the answer often reveals itself faster than anyone expects.